Ladies and gentlemen, welcome once again to another episode of the Think Clinical Podcast. My name is Hamza. If you haven't done so already, please remember to subscribe, like, and share. This is going to be another very exciting episode, and today we are going to be looking at just generally funding. And I have done a couple of episodes on funding and where to look for funding and what you need to do when you need funding for your healthcare business, especially in Africa, where funding is declining over the last couple of years. But today we are going to look at this from a different dynamic, from how you bootstrap to smart capital, so like what I call smart capital. And so you need to look at this as one of the biggest tools you have as a healthcare entrepreneur, and one of the headaches you have, because one of the things that would keep running through your mind is, I need money to grow my clinic. I need money to grow my clinic. But that's what every healthcare entrepreneur says. What investors hear is that I need money because I haven't figured out how to be profitable yet. So today we're going to be looking at this in a different light and helping you understand how to really position yourself to be very attractive for this. So in 2024, for instance, African startups raised 2.2 billion, representing 25% decrease from 2025. Now, money is getting tighter, so investors are beginning to get very picky on who to invest in and who not to. And most healthcare founders, they are still pitching like they are pitching in 2021, forgetting that funding is declining and people are becoming more picky, especially from the investment side. So today we are talking about the most misunderstood topic in healthcare business. And again, I keep talking about capital because it's very important, and people are just not getting it. But getting it right at the right time without losing your clinic in the process is the most important thing that you can do for yourself. So we need to look at this in a bigger perspective. So now, the funding mistake that kills most people's dreams is that most people raise money too early in their business, or they attempt to raise money too early in their business. So let's say you have a dream, which most entrepreneurs have. You've got a medical degree, which most entrepreneurs, or some of the entrepreneurs in healthcare especially, would have. You create a pitch deck with beautiful renderings of your future 50-bed capacity hospital, and you project 10,000 patients monthly, and you need $2 million to get started. Now, the investor reaction in this situation is going to be what? Guess. Silent. Why? Because you have to come back when you have traction. That's the commonest statement you hear from every investor who you walk to and tell them that this is the dream, and these are your renderings, and these are the things that you think you can make. Now, when you hear this, investors aren't funding dreams anymore, and that's the one thing that you need to understand. In 2024, and I'm using 2024 because that's when we had the last very concrete data, 50 deals funded 50 deals funded African healthcare startups with a focus on companies demonstrating proof of concept and clear path to profitability. So this is not just a matter of now going out there to sell a dream. You should have demonstrated that your concept has some legs to stand on, and it can actually generate what you're saying or proposing it will. And they want answers to very, very brutal questions. Do patients actually want your service? And you need to prove that by actually doing it. Can you acquire patients profitably? Again, you need to do that by implementing it out there. What's your unit economics? And why can't you bootstrap to prove your model first? These are the things investors are going to be asking you, so you need to actually pay attention to some of these things. Now, the companies that have raised significant funding had one thing in common. They all showed proof of concept. So today I'm starting this podcast letting you understand that before you actually go out there chasing money, there has to be proof of concept. And so what do we need to do? How do you get there? The first thing you need to do is bootstrap. Whether you like it or not, you need to have skin in the game. You need to invest a piece of yourself, or maybe family and friends who trust in your idea, to be able to prove that concept. Now, let me tell you something controversial. The best businesses don't need much capital to start. Somebody will tell me that's bullshit. Okay, that's fine. But what you need to understand is that you need to start small, at least way smaller than you think, because a lot of the time, and as an entrepreneur, I will tell you, we think way too big in the beginning, but you need to start small whilst you think big, right? So you know where you want to get to, but you need to start so small, and that is why that statement is correct, that you don't need so much money to start. You don't need a big hospital because you can afford it. You need 2 or 3 or 4 rooms that you can use to prove your concept. You grow quickly in your early stages, and then you can use that traction to go back to the investor and say, look, if this was in this space at this magnitude with this level of investment, this is what I project, because I've been able to model this out over the last 2-3 years, and I've been able to show you that this works. Now, the one thing that you have to also look at is that bootstrapping is very important for every entrepreneur, because what that does for you, especially because it's your money and you don't have enough of it, it teaches you how to acquire a patient cheaply, because you have no choice, right? It also helps you understand which services are actually profitable, because you need your money back so that you don't run out of losses. You can't afford those losses. It helps you to know how to operate efficiently, so you know every single dollar counts and whether patients actually pay. And that's the ultimate validation for your concept and for your idea. So bootstrapping is very important, and that's where you need to start with. Where do you get this from? Your personal savings. Get enough money that gives you a 3 to 6 month running. Family and friends can help you get your equipment. Vendor financing can help you with supplies. Revenue from day one to fund growth. You can actually get things that will help you start from the beginning. Now, the second stage of it is now to identify when to raise funds. And you are only ready to raise capital when you answer these 3 questions with numbers, not just hope and not dreams. What's your customer acquisition cost and lifetime value? And I spoke about this in one of my videos, how you calculate your customer acquisition cost and your lifetime value. And you should know this to the last dollar. The second thing is that what will you use the money for specifically? Don't just say, I want to use to grow. I want to open 3 new locations, each of them generating X amount of money of revenue within this Y amount of months, right? That has to be clear. And what happens if you don't get funding? Your answer shouldn't be that you will die, which means you're not ready. You have to be able to show an alternate route if you do not have funding. This tells investors how ready you are to be able to adequately manage your finances and to manage any resources that may throw at you. Whether adequate or inadequate, you know how to really get that and turn that around. So healthcare has actually maintained a steady performance since 2024, with 14% deals by volume and 16% by value in the first half of the year. Who is actually investing? That's the question you should ask. The most active investors include DEG, which is the German Development Finance, Launch Africa Ventures, 54 Collective, and Transform Health Fund by African Invest. These are the investing. But do you notice a pattern? Development finance institution, local funds, and specialized healthcare investors, not generic VCs. These are very specific people who are investing in healthcare in Africa, and these are people that you should be paying attention to. So what they want, you need to show them impact and returns. Healthcare investors execute deals supporting high quality hospitals with shares in $125 million financing facilities. They want financial returns and measurable health impact. So first is health impact, or impact and returns. Second one is proving models, which I said you have to go out there and make sure they are proving your concept before. And the third one is local sustainability, not dependent on continued foreign aid, but you have to be able to show that your idea locally can be supported. You need to look at your capital, or what capital is available at each stage. So pre-revenue, before you start making money, if the opportunity for grants, go for them. The competitions, the accelerators, those are places that you can make money to actually start expanding this dream. And then you look at early revenue. When you start making some money, then you can look at angel investors, you can look at seed funds, you can look at healthcare focused funds like IFHA with 170 million euros in assets. That can help you when you start making early revenue. Now when you have proof of model, then you go for growth equity, you go for debt financing and development finance institutions like DFC. So you look at two things, and I'll quickly talk about this: debt versus equity. And this is a choice most people will actually get wrong. So here is what nobody will tell you: equity is expensive, right? But most people will lean towards equity any day. Now you raise 500,000 for 20% of your clinic. It seems reasonable, but fast forward 5 years, your clinic is worth 10 million and the investor's 20% is worth 2 million. So you just gave away 1.5 million in value for $500,000 in cash. That's the reality of equity people don't understand. But this is when equity makes sense. When you are pre-revenue with high risk, anybody who is willing to take that risk with you deserves the equity or the value of the equity they get. You need lots of capital for infrastructure. Yes, it definitely makes sense. And you want strategic partners beyond the money, so the network, the expertise, the counseling, the whatever the value they bring. Yes, then the equity makes sense. Now when does debt make sense? You have consistent cash flow to service repayments, so you know and you can predict cash flow. Go for debt. You are using capital for revenue generating asset like equipment and new location. Debt will be important, and you want to keep 100% of your ownership. This is very important. So in the first half of 2025, debt financing grew significantly with 137 million raised by Senegal Wave in a record-setting round. So this is very, very important. Just so you know, debt is cheaper than you think if your economics actually work, but you have to be very smart with your debt. The last thing I would like to talk about is becoming investment ready. And most founders think investment ready means they have a pitch deck. That's completely inaccurate. This is what investment ready means: your financials are clean, you're not complicated, you're accurate, revenue, cost, profit, loss monthly. If you don't track it, investors assume you're hiding something. So they have to be very clear, very simple to understand, very easy to follow. That's the first thing, which means that's when you're investor ready. Second one is clear use of funds. So you have $500,000 for, maybe allocating $200,000 for equipment. It generates X additional revenue. $150,000 for marketing. At our proven customer acquisition cost, it brings Y new patients, and then $150K working capital, 6 months runway for you. You have to be very clear on how you use funds. And the third last thing that helps you to be investor ready is realistic projections. Corporate venture capitalists are focusing on startups with proven models and hard currency revenues rather than following market trends. Your 5-year projection shouldn't show hockey stick growth. It should show steady, believable expansion based on your proven model. And you have to, at the base of all this, show strong governance if you want to be investor ready. Here's the paradox: the less you need investor money, the easier it is to get it, because you have been able to build a company and a model that is so profitable that you do not actually need investor money, but then it makes you very attractive to investors because you have all this cash flow that's available. Raising capital becomes a fuel for a proven engine, not a prayer that the engine would eventually start. This is something you need to keep in mind. So the money is actually here. The question is that, are you fundable? And if you want to build your company into an investor-ready company with all the metrics and everything you need to do, please feel free to contact us. We are happy to help you and see where you are, and then we can help you grow from there. This has been another episode of the Think Clinical Podcast. Thank you so much. We appreciate everything you do for us, and do have a great day.